In this question, you have to put together a schedule of costs of goods manufactured, and it's for the month ended August 31st. So I think the quickest way to do it is to just fill in all of the headings first, and then we can work on the numbers. So every schedule of costs of goods manufactured is set up the exact same way, except for the manufacturing overhead, where there might be different types of actual factory that are in different types of questions or businesses. So I'll start with raw materials at the beginning of the year. Then you add in your purchases, and then that gives you a subtotal for what's available. Then you subtract your ending raw materials, and then that will give you your raw materials used. The next step is to add in your direct labor, and then we can start working on the manufacturing overhead. So this is all of the actual overhead. So I'll skip this part just because I'll have to read more into the question to see what the overhead is going to be. And then after we add all that up, you'll get total overhead costs, and then you add up your direct materials, direct labor, and overhead, and that will give you your total manufacturing costs. Then we're going to add in our work in process beginning inventory, and then subtract our work in process ending inventory. And then that gives us our cost of goods manufactured. And while I'm here, the top part of the income statement is set up the same way as well. It'll start with your sales. And then we're going to calculate our cost of goods sold. So I'm going to move into the finished goods inventory account. So we'll do finished goods beginning inventory, and then we'll add in the cost of goods manufactured. So that's the number from the last sheet. That gives you what's available, and then we're going to subtract our finished goods ending inventory. That will give us our cost of goods sold, and then we can get our gross margin. Or you could even be in a loss position, but I'll put gross margin for now. And then the operating expenses could be different in different types of questions, just because they could be named something different. Yeah, okay. So now let's go ahead and fill in the numbers. So the raw materials beginning inventory is 31, so I'll put that here. Then my purchase of raw materials is right up here. It just says raw material purchase, 226. Then that gives me my raw materials available of 257. I subtract my raw materials ending, which is 78. And then that gives me my raw materials used in production, which is 179. Now I'm going to go ahead and add in the direct labor. So that is 80,000. And now I have to scan and read the additional information for the manufacturing overhead. Okay, so indirect labor costs is one of them, so that's 9,000. So I'll put indirect labor costs, 9,000. Then I see utilities. I'm not sure if the full 25,000 is manufacturing overhead, so I'll have to read the additional information. And it says 80% of the utilities is for factory. So I'm just going to use Excel just to make a note of this. So total utilities is 25,000. So manufacturing overhead, so that's the utilities that has to do with the factory, is 20, and then that means the difference, so the remaining 20% is selling and admin, or I'll just say operating expenses. So you can either just go 25 minus 20, or you can do 25 times 0.2. So I'm going to go ahead and put the utilities in under the manufacturing overhead for 20,000. And then I'm just going to work on both statements at the same time. I'm going to move down to the income statement, and I'm going to put those utilities down, and I'm going to put the other 20% here. So that's 5. So what I'm doing is I'm breaking up the utilities that occurred at the factory and the utilities that occurred at the store. Okay, then direct labor costs we already used. Depreciation, it says for factory equipment, so I'm going to go ahead and put that down here. And what was that number again? It was 21,000. So if it said depreciation store, then I would have put that depreciation down on the income statement. So your product costs belong on the cost of goods manufactured schedule, and your period costs belong on your income statement. So like this one, depreciation sales equipment, I'm going to go ahead and put that one on the income statement. And I think that was 8,000. Then I'm looking at the insurance and it says 8,000. So I'm not sure if that insurance is factory or if it's store. They'll have to tell me additional information on that. So it says 50% of the insurance applies to the factory operations. So I'll just half that. So insurance for the factory is 50%. So I'm just timing that by 50. And then insurance under operating expense is 50%. So I'll move this 4,000 of insurance onto the cost of goods sold statement. And then I'll move the insurance for the store on the income statement. Okay, now I see rent on facilities. So I would automatically think the facilities is the factory, but I think in this case it's the rent for the factory and the store. So I just got to see how they're splitting this up. So in Part C, it says only 60% of the rent on facilities applies to factory operations. So I'll do 60% to the factory, so 60%. And then the remaining, I'll put to operating expenses. So 48,000 for manufacturing and 32,000 for operating. Okay, then I have selling and administrative salaries. So that just has to do with selling the product and working at the stores or head office. So I'm putting that one right on the income statement because that's a period cost. And I believe that was for 22,000. And then my advertising, obviously for the product. So that's a period cost. So I'm going to put that down here. Advertising for, I think it was 65,000. Okay, so I think I picked up all of my expenses or my costs, and then I segregated them between manufacturing costs and selling and admin costs. So now what I can do is just finish my cost of goods manufactured statement. So the only parts that I haven't added is I have to add up this manufacturing overhead. So I'm just going to do 9,000, 20,000, 21,000, 4,000, and 48,000, and just add that up. So I just like using Excel better than the calculator to do my adding, because then I can see what I added. Okay, so that's 102, and those are my Oh, wait a minute. Those are my total overhead costs. It already added that up for me. So I see a blank space here. You don't always have to add information into it. I'm leaving that blank because there's no more manufacturing overhead costs. Okay, so my work in process inventory at the beginning is this one right here, the 18,000. So I'll put that in. And then they total the work in process together. So that's the 361 and the 18. And then my work in process ending is this number here, the 10,000. So that gives me cost of goods manufactured of 369. And I know I'm going to bring that number down and put it right here, 369. So they have to give us the sales, and they also will need to give us the finished goods inventory balances. So the sales you can get from the income statement, which is the 530. So I'll put that down. And then my finished goods inventory, they gave it to me in the question, just right here. So the beginning is 50 and the end is 55. So I'll put the 50 in. So the finished goods beginning plus the cost of goods manufactured equals the goods available for sale. And then if we minus our ending, which was 55, then that will give us the cost of goods sold number of 364. And then all I need to do now is take the sales of 530 and subtract the cost of goods sold, and that will give me my gross margin. So it's positive, so I'm going to put it as 166. So I already listed all of my operating expenses. I don't need to fill in all of the squares just because there's no other operating expenses that I identified. So what I'm going to do is I'm just going to subtract the 166, which is the gross profit, from the operating expenses. And that gives me 30,000. So since it's positive, that means I have net income. If it was negative, I would call it a net loss. So then number 3 says, on the basis of your statements prepared in requirements 1 and 2, would you recommend that the company looks for a buyer? And I would say no, only because they have a positive gross margin and also they have a positive net income. So it looks like the company's doing fine.